And in 33, everyone had gold. When Roosevelt confiscated gold as his first act in office in April of 33, everyone had it. It was money in their pocket. Everyone had it. So, and it was less a big deal. Also, you had a country that was probably far more patriotic as a whole than they are today. I don't think it would go very well right now. When the price got nailed down, immediately you have all these contracts that are purchased and will stand for immediate delivery. So there's a lot going on with delivery that is maybe not as easy for people to gauge just by looking at the first day delivery. But I would argue that would probably be a very big one in December, and that will answer your question largely. Who took massive positions and is having it delivered into COMEX? Doesn't mean it's leaving COMEX, but it's under their control within the COMEX ecosystem in an eligible account. I think it won't be easy. I think there'll be a lot of volatility like we've seen, but I think it's unquestionably this is the trend. And just as a side note, you want to talk about where things are going into the end of the year. I was reading something this morning that there's some institutional traders that see a massive breakout in gold in the next few weeks. And I'm not saying it's going to happen, but we just saw a $96 million coordinated call block, it's called, just hit GLD, which with calls expiring in December. This means that an institutional investor or multiple funds in coordination just bought roughly $96 million worth of GLD call options.
Okay.
And a call option profits when the price goes up. And with the December expiration, they're betting gold rises within weeks before those options expire. And when you call it a coordinated block, this means that one or several large orders are placed together. And this suggests intentional institutional positioning, not retail speculation. So in plain English, this means that someone with some serious capital believes gold will move sharply higher soon to put a $96 million bet on it. And then you look at the deliveries we've seen in October, which is a pseudo delivery month in gold. It's turning out to be maybe the third largest delivery month in all of 2025, and it's not even a primary delivery month for October. And November deliveries are again, as I mentioned, off to a big start. December is the big one, where both gold and silver are delivered in December. So it might have something to do with that and how much of it will be delivered. Mm-hmm. It may have something to do with the Fed pivoting and lowering rates again. I mean, all I can tell you is that everything that I see is very bullish, and I try and be as open-minded as possible. I'm not married to the bull. I just simply think when you look at the positioning of the biggest money in the world and all the actions going on by the governments around the world, it's hard not to be when you look at this from a big picture.
Evidence of this rising conviction surfaced in a remarkable order recently placed on GLD, a $96 million coordinated block of call options expiring in December. Such trades aren't typical retail enthusiasm. They're deliberate, strategic wagers placed by entities with deep market insight and substantial capital. Calls only pay when prices rise, and the short time window implies an expectation of movement soon. Coordinated blocks also signify institutional alignment, where multiple large orders are executed simultaneously. In plain terms, someone powerful is betting heavily on near-term upside in gold, and that vote of confidence often precedes meaningful price action.
I'm a little confused on that one because if I'm not mistaken, I think their calendar, you're already into the first quarter of their next year calendar, if I'm not mistaken. In other words, I think that they don't work on the calendar we do.
I think a lot of these guys do. It depends on the fiscal year of their company, but a lot of them are tied to the calendar year. But I guess my question for you is, just having worked in the precious metal space, do you see the sort of end of year window dressing with the precious metals when they've had a blockbuster year like they've had now, or not?
I mean, that's a tough one. I would say that this bet certainly would pay homage to that is the
looks
case.
like an example of that, yeah.
But look, all of this stuff has been going on. I think we'll know more first day December deliveries. What interesting thing is that we've been seeing huge amounts of mid-delivery cycle deliveries where immediate contracts are issued. for delivery, like record amounts. And that happened right around the time when the market got nailed down a couple weeks ago, where the majority of contracts that are going to deliver are announced on the first day of delivery. But then 3 days in a row, we got records. Something like 6,000 gold contracts were issued over 3 days for immediate delivery. That normally doesn't happen. Normally, yeah, we're going to stand for delivery, but on the 15th, 16th, 17th, or whatever of the month.
Beyond derivatives, the physical market is flashing equally compelling signals. October, a secondary delivery month, is shaping up to be one of the largest gold delivery periods of the entire year. Even more unusual is the surge in mid-cycle immediate delivery contracts, where thousands of contracts were demanded unexpectedly during periods of lower liquidity. Moments after paper prices were pushed sharply down, buyers stepped in demanding physical bars rather than rolling positions. This type of activity suggests strategic accumulation rather than routine trading. With December being a primary delivery month for both metals, pressure on COMEX inventories could become a defining moment.
When the price got nailed down, immediately you have all these contracts that are purchased and will stand for immediate delivery. So there's a lot going on with delivery that is maybe not as easy for people to gauge just by looking at the first day delivery. But I would argue that would probably be a very big one in December, and that will answer your question largely. Who took massive positions and is having it delivered into COMEX? Doesn't mean it's leaving COMEX, but it's under their control within the COMEX ecosystem in an eligible account. I don't think so. First of all, I think the CPI should be called CPLI, and the Bureau of Labor Statistics should be BS. Yeah, well, I mean, look, you can look at the other side and say for the multifamily mortgage-backed securities, their delinquency rate rose to 7.1%. It's the worst since 2015. And multifamily mortgage-backed securities are backed by rental apartment property mortgages. So, this is kind of why this is happening. It's because the delinquency rates are real. The consumer is hurting. We have a K-shaped economy where the rich are getting richer and the poor are getting poorer. So what is the Fed doing? They have quietly come in and pumped in at $150 billion into the banking sector quietly over the last several days. They're doing this not to support jobs. They're doing it to save the banks. And
is that through repo? Is that what you're talking about when you get that number? Okay.
Yes.
Yeah.
And liquidity is drying up, and Wall Street needs cash. So, yeah, I think that you're going to see inflation not be as easy to tame as they want us to believe. And I don't even know where those numbers came from, because I thought that the Bureau of Labor Statistics was closed with the rest. Yeah, I don't know if those are numbers printed by private entities or what.
They might be private rent. Yeah, I don't have them at my fingertips. I don't know, but yeah.
But the Fed said they're going to stop QT, and it's not because inflation is beat or growth is slowing. It's ending it to prevent a liquidity crisis.
Right. Although growth is slowing, but yeah.
Yeah, but I agree, but I don't think that's why they're doing it. They're doing it to prevent a liquidity crisis.
Yeah, I agree. They're doing it as defensive measures. Yeah, exactly. Against those
it's concerns. Like it signals something deeper is wrong. Let's just put it to you that way.
Yeah.
While gold demand rises, underlying financial stress also appears to be intensifying. Multifamily mortgage-backed securities have reached their highest delinquency rates since 2015, signaling strain in segments once considered resilient. At the same time, the Federal Reserve has quietly injected over $150 billion into the banking system through emergency liquidity operations. Despite public assurances, these interventions look more like defensive measures intended to stabilize strained balance sheets than an effort to manage inflation. With growth slowing and liquidity tightening, gold's appeal as a hedge rises. Market participants increasingly interpret the Fed's actions as confirmation that deeper systemic issues may be unfolding.
If the world saw eminent domain and taking of U.S. gold and silver when countries like China have state-sponsored accumulation programs, it is game over. But it's interesting, who is the custodian of the world's largest silver trust, SLV, and one of the biggest in GLD? It's BlackRock and JP Morgan. They're the primary custodians. And JP Morgan, who paid that largest fine ever issued by the Justice Department a few years ago, $920 million for manipulating the metals market, spoofing, they called it, when people thought they were going to get brought up on RICO charges. They kind of got off with a slap on the wrist. Their head trader, who I had sat at a lunch table with, Michael Nowak, I think is still in prison for it. But they're allowed to be the custodians of the largest silver trust in the world, SLV, and one of the largest gold stockpiles in the world, GLD. So on a Friday night, instead of activating eminent domain, to your point, to risk that global backlash, we will never trust you again. It's one thing to take Russia's treasuries, which is bad enough, but now you take your own people's gold. They could take those two accounts, and in the prospectus of those two accounts, it says you and I, unless we have a basket which is tens of millions of dollars worth, and they can stop that too in terms of redemptions. But you and I, we can't redeem it. We can only get paid back in cash. So you wake up Monday morning and the 2 million you had in GLD and SLV are now sitting in your money market, and they say, go buy Eagles, go buy whatever you want. We didn't make it illegal. We just closed the funds that are being held with a pink bow wrapped around them by JP Morgan and BlackRock. And so I would say I think confiscation is highly unlikely. And if we did cross that point, we probably have bigger problems at hand to worry about. And eminent domain says they have to pay you a fair price. Again, being paid in dollars, which is an interesting point, because against the basket of crappy currencies, the dollar's down 8 or 9% this year, the index. But against silver, it's down 70. Against gold, it's down 55 or 60. Mm-hmm. And so, yeah, you don't want that to happen, but I don't think it will. I think they could take the ETFs and have their cake and eat it too.
Some investors express concern about the possibility of government gold confiscation during financial stress, but modern mechanisms make that scenario unlikely. Instead of seizing personal holdings, authorities could simply restrict redemptions in major ETFs such as GLD or SLV, both custodied by JP Morgan and BlackRock. These funds already limit physical redemption to large basket holders, effectively excluding ordinary investors. In an extreme event, the government wouldn't need to confiscate anything. They could close redemptions and convert shares into cash, leaving physical metal under institutional control. This loophole makes private physical ownership more critical for those seeking true autonomy.
And in 1933, everyone had gold. When Roosevelt confiscated gold as his first act in office in April of 1933, everyone had it. It was money in their pocket. Everyone had it. So, and it was less a big deal. Also, you had a country that was probably far more patriotic as a whole than they are today. I don't think it would go very well right now. I think that there are a lot of things at play when they knocked it down. The answer is yes, but I think you have to examine what happened when they knocked it down. I mean, it got knocked down in 2 days. You saw in both instances, a couple weeks ago, you saw massive amounts of gold and silver dropped in what's called the access market. It started anyway at a period of time in between New York closing and Asia opening. There's no liquidity in the market there. And when this happens, it would be the worst possible time to ever do it. In fact, there wouldn't be a trader on the planet that would ever do it. If they did, they would be fired and shot, and probably not in that order, as you're dumping copious amounts of gold and silver onto the market when the New York traders are gone for the day and there is no liquidity in the marketplace. And it hits stops because there's no one there to fill the order, so it just triggers stops all the way down. It's a drive-by shooting.
Gold's dramatic sell-offs often occur during thinly traded hours, triggering cascade effects as automated algorithms dump contracts. These steep, short-lived declines rarely align with rational trading behavior, suggesting intentional attempts to push prices lower. Yet recent episodes revealed a new twist. Major U.S. commercial banks, including Morgan Stanley and Bank of America, stepped in aggressively to buy physical metal immediately after forced selling hit. Both institutions have recently raised their recommended gold allocations to unprecedented levels. Their rapid accumulation signals confidence, not fear. Despite engineered volatility, gold continues to show remarkable resilience, reinforcing the broader trend toward long-term accumulation.
The interesting part about it was that Michael Lynch, I believe is his name, I think that's his name, an analyst who talks about the COMEX says, you know, there was interesting movement when the price got slammed down. Two American commercial banks came in and bought massive amounts. It was Bank of America and Morgan Stanley. They came in and literally silver went right back up, and gold came up about halfway because it had hit so many stops on the way down, where funds that use algorithms to, you know, trigger sell limits or sell orders just fall. The interesting part about Morgan Stanley and Bank of America is you have the chief investment officer, of course, of Morgan Stanley, it's well known now, that said sell half your bonds and put 20% of your assets in gold. And then Bank of America lead analyst Michael Hartnett is saying, yeah, make that 25% in gold. And so these two banks came in and gobbled it up. But when you look at how this has tremendous strength and resiliency, I look back over my career, Adam, and any time that the market got hit this hard, they'd step on its neck and it would never come back. You know, everyone was saying, this is it, it's over. Gold broke 4,000, silver broke 50, the bull run is over, sell your gold. Yeah, it never left. And it was done. If when the media said that, they said, by the way, the start of this massive sale happened when no rational trader would have ever done it. It was dumped in the middle of the night when there was no liquidity. This would have been done over hours or days during New York trading, not bang when there's no one there. If they would have said that, I think the market may have looked at things a little bit differently. Oh, I see. And then two big U.S. commercial banks who have changed their allocation recommendation to gold came in and scooped up physical on the cheap. There are a lot of games going on, bottom line. And I think you just have to have strong fingertips and see the bigger picture.